Hey, hello. Today is Monday, August 19th, 2024, and I have the pleasure today of speaking with an old friend of mine, an old colleague of mine, Mark Serafini. And I thought it was going to be good to bring Mark on board here because Mark knows a lot about options, which is something that I do not even pretend to know a lot about. I don't trade them at all. But I know that there are people that listen to us and that subscribe to our service that are interested in options. And so I thought I would bring along somebody who did know a lot about that. And like I say, in particular, he's not your typical guy that's going to give you your typical options stuff. Mark, like most people who I have worked and associated with, likes to take a little bit of a different view towards things, which I always think is important because if you're going to take the same view as everybody else, then you're going to end up with the same returns as everybody else, and that's going to suck. So taking a little different view on it can help to give you an edge in things, no matter what it is, including how to do options. So given that I don't know a lot about this stuff, I'm going to let Mark do most of the talking, and I will try and answer questions along the lines of what I think people would want to hear. But anyway, from there, go, Mark. Tell us what you do. Tell us how we can make money from options, and tell us, yada yada.
So the interesting thing, I'll start with a little background. I started my career in equity derivatives. I was on a prop desk at Spear Lees and Kellogg, Bear Wagner, Kellogg Capital Group, and 4 or 5 of those years I ran options books. And then I left and went into the multi-asset space and ended up meeting you, and then we worked together. And then once COVID hit and they sent out stimulus checks, a lot of that money made its way into the option space. And what happened was the hedge funds aren't stupid. They see this volume, they go, okay, well, there's something we can do about this. And then the business exploded. So now the open interest in equity options is bigger than the cash business. So if you're going to trade stocks, and more importantly, stock options, you better have some understanding of what the dealers are going to be doing to hedge their exposure, or you're going to be wondering why the market's doing what it's doing. And it's different than futures. And if I sell you a futures contract, it's zero sum, right? I make, you lose, I make. It's not the same way in options. When a dealer sells you an option or buys an option from you, they replicate that exposure with delta hedging, gamma hedging, blah, blah, blah. So what happens is it's a similar situation like we used to look at with COT, where if the market goes in a certain direction, how people have to behave, how those agents are going to behave, right? If they're short and the market's going up, they're going to have to cover. Well, with options, if the dealer is long or short the higher derivatives, gamma, vanna, charm, beta, etc., depending on what their books look like and where the market is, generally speaking, institutional investors sell out of the money calls and buy out of the money puts for hedges. They sell the calls for yield enhancement to add returns, and they buy puts for a hedge. Generally speaking, that's kind of the way the option business works. And the dealers or the market makers on the CBOE, wherever it is, they end up with all those options on their books, and they hedge the books themselves. So they're going to be in there either amplifying volatility when they're short those second and higher derivatives, or they're going to be compressing volatility when they're long those higher derivatives. So what I started to do, I noticed, was starting around 2020, in the middle of 2020, as all these options started getting more and more popular with retail investors, the hedge funds said, wait a second, we can arbitrage this in terms of our clearing firm, because we can put these trades on in the middle of the day, and by the time the clearing firm knows about it, it's already expired, right? So the zero days to expiration options started getting huge. And that's kind of where I've been focusing the last couple of years. And the difference between, let's say, a 3 or 6 month option and a 0 DTE option is 3 month and 6 month options are ramp options, right? So meaning your Greeks are going to be curved and they're going to be kind of smooth. The further out you go, the less convexity there is, right? If you trade a 0 DTE option, it's essentially digital. They're very sharp curvatures, convexities. And I recently set up a Twitter page, a Twitter handle called Steep Greeks, because these Greeks are very steep. They're digital. And when I worked for John Mulhern back in 2001 and 2, I kind of ran a strategy that taught me a lot about really short-term options, because what we would do was the specialists would call me up. I had about 5 specialists I dealt with. They would say, hey, look, I got a guy who wants to sell 300,000 Smith International. I'll take 100,000. The crowd will take 100,000. Where can I lay off 100,000? So I'll look at the options. Say, look, down 20 cents, I'll take it from you. So he would sell me the stock. I would sell deep in the money calls, and that would become a synthetic short put. And I would manage that for between 1 and 3 weeks. And then that position, we would just let it roll off because it was usually deep in the money. But what you find out is when you get down to the last 2 or 3 days before expiration, you can't really delta hedge these things because it's like above 100, you're flat, and below 100, you're short 100,000 contracts shares. So if you did that all day long in the last couple of days, you just get whipped all over the place, and that 20 cents that you sold that option for would have disappeared in about an hour. So you have to understand how these things are moving and what's driving them, and how quick you're going to go from, like say a 40 delta to an 80 delta. And if you don't know what you're doing, you're going to get whipsawed. And with these zero DTE options, a lot of the hedge funds are out there. What they'll do is they'll trade them in the morning, and they'll sell condors, iron condors, or some straddles or something. But just selling those options, there's no edge in that if you don't know how the dealers are leaning. If you look to so you were away last week, but we got a little bumpiness in the markets, right? So during those days, the dealers were short the higher moments, Gamma, Vanna. So what happens is as the market goes down, they're going to have to hedge in the direction of that risk because they're short out of the money downside options. So what happens is the market goes down, it's a stop loss order, essentially. They got to sell. It goes down more, they got to sell more. It turns and goes back up, they got to buy. So the market gets whipsawed all over the place intraday. And if you're trading these things, just selling straddles or iron condors, it's going to be tough to do. Whereas if you look at what's gone on the last couple of days, Friday and today, now the dealers are in an environment of positive gamma in Vanna. So as vol goes down and price goes up, they're acting to compress volatility. They're selling rallies and they're buying dips. It's a limit order mentality. So if you understand how these dealers or market makers are positioned, or generally speaking, you don't need to know exactly because it's almost impossible to get it to a granular level. All you really need to know is, are they in an environment where they're amplifying volatility, both realized and implied volatility? And implied volatility is just simply the price of the option. You back out what the implied volatility is because through the price of the option, right? So just not even knowing anything about options, you just say, okay, well, the spreads are wide and option prices are high. Essentially, you can pretty much get a good idea that there's no liquidity and the vols are high. It's the opposite when we're in a situation like we were today, where vols are getting squeezed again, bid-ask spreads are tight. And what happens in these situations is not just the option dealers that are doing these things. You have vol control programs at insurance companies or minimum volatility strategies at mutual funds and real money shops, where all they do is their position is based on a range. Their leverage is going to be depending on 1 over variance, right, or 1 over sigma. So as realized volatility goes up, they sell to minimize their exposure, and when realized volatility goes down, they add to it. So you have multiple agents. You also have high frequency market makers, which do the same thing, but they just do it at a high frequency in terms of their bid-ask spreads intraday. So you have all these people that have very simple reaction functions, whether that's I'm trading my Greeks based off how implied vol and price moves, right, Gamma and Vanna, or if I'm in a vol targeting firm where you say, look, I have a 10% vol target on my portfolio. Vols are going up. I got to take some risk off to keep that vol steady in my portfolio. Or if it's high frequency market makers, where they're infamous now, where as soon as realized vol starts to go up, they just stop making markets and the liquidity dries up, right? So you get these intraday gaps. So you have all these players interacting, and it becomes a networking effect where they all end up doing the same thing for different reasons. And CTAs, you can throw them in there too, because price starts going down. You saw the last couple of weeks they had to sell, right? The short-term guys first, then the medium holding periods, and the longer-term guys probably didn't sell, because I think right now I saw a piece from one of the brokerage houses this week. The CTAs probably cut about 2/3 of their equity exposure, with the longer-term guys like Dunn or some of those guys that are always in the market. They probably didn't sell, but they're doing the same thing too. It's just on a longer-term horizon. So you get this complex system evolving based on very simple things: price and volatility, whether that's implied or realized. And it's not that the feedback mechanisms of all these agents are pretty simple to follow. I mean, you don't have to be a PhD in math to figure this stuff out. It's pretty simple, right? So I track all these guys, and I see which way they're leaning and say, how are they going to behave if the market does X or Y? And if that's generally what I've been doing recently. And I've had quite a few options consulting clients call me up, RIAs in particular, one OCIO and one 40s Act fund, where after 2020, they're stock pickers and they were kind of confused as to what's going on in the market, especially on expiration. Because with these dealers, as you go into expiration week, which we had last week, if they're in a negative or positive gamma environment or Vanna and charm environment, they're going to react completely differently. Last week, it was kind of choppy because we were more negative Vanna and gamma, and the charm effects weren't your typical, where generally speaking, if it was a quiet week going into the expiration, all the out of the money calls that the institution sold for yield enhancement end up on the dealer's books. And what happens is they're generally 30-day options. The dealers will sell stock against it. And as we get closer to expiration, that delta will bleed down to nothing. So if you had a 25 or 30 delta option that you sold 30% of the stock against, now you're at the week of expiration, that delta has been disappearing just because of time. Because in options trading, volatility and time have the same effect, right? If the time is expiring, the price, your theta starts getting stronger, right? You're losing more money as time gets closer to the expiration. The same thing happens with option. As vol goes down, it's as if you shorten the time. So in options, they're three-dimensional, right? With a futures contract, you're just pretty much worried about direction of price, right? But in an option, you got to worry about price, vol, and time. The good thing is vol and time are pretty much the same element in a Brownian motion or the way they model these things. So if vol goes up, your option feels like your time has been extended. Let's say you had a 2-week option and vol goes up. Well, the price of that premium is going to go up because the vol went up, and it's going to act like, okay, this option is going to act like it's a longer term option because the vol went up. If vol goes down, let's say vol went to 8 on the S&P, well, those 2-week options would act like a 3 or 4 day option because of the way these inputs, because they're multi-dimensional inputs. But like I said, vol and time have the similar effect. So it kind of makes it almost two-dimensional. So those are the kind of things I watch for. Then, of course, I look at, where on the price chart are we, where has the market been trading during the day? Like today, I was looking at the market. We were in a positive gamma environment. At 2:30, we were on the highs. And since we're in a positive gamma environment, I said, okay, well, at 2:30, you probably want to be selling the out-of-the-money put spread for whatever you could get for it, because likely the market's not going down between now and the close. And they jammed it up through the round number. So that was the type of trade I would do in a day like today, where we're in an environment where we're at the high in the price from 9:30 to 2:30. And we're in a positive gamma environment, meaning the dealers are going to buy dips and sell rallies to compress vol, which is kind of what they do. But they were kind of doing today as vol, it accelerates the trend. Whichever direction of the trend is in, is kind of squeezing it up that way, but tighter and tighter. So that was kind of something that would have been interesting today. Whereas last week, the dealers were in a negative gamma environment. So you either wanted to, depending on where you were at 230 in the price, if you're in the middle of the distribution, you might have wanted to buy a strangle or something like that, where you think it was probably going to go to one tail, or if you're in one of the other tails, you would have thought it was going to go the opposite tail. So that's kind of what I've been doing recently, and I'm going to start doing more and more, if putting up more information in educational stuff on my new Twitter account, Steep Greeks, and that's kind of what I'm trying to do right now. Since I've gotten a lot of people, like I helped a guy and he runs an IRA in St. Louis. He has, I don't know how many 100 million of retail clients that have stocks, but they wanted to do some yield enhancement. So he wanted to do condors, iron condors. So I helped him with some of that. And now he's got a guy that's programming it all up for his API through interactive brokers, so they can do that. That's one of some of the options you could do, but he just wants to do the, collecting premium. There's more ways to do it than I wouldn't want to just keyhole myself just to that. That's why I look at, he wasn't too interested in what the dealers are doing. He just kind of wants to do condor. So I helped him with that. That's kind of what I've been doing lately. So that was a long-winded.
No, it's good. So that's a lot of very big words, many of which I don't understand. It's also a lot of, look, if the market's going to go up, you want to be, long. If the market's going to go down, you want to be short, which we all know, right? Can you be, and you were a little bit, but can you be a little bit more specific about a strategy?
Yeah.
It sounds like it sounded, and tell me if I'm wrong, but these 1 day to expiration options, but you're waiting until 2:30.
Yeah.
Which I know is an important time in the market. For me as well. I've always looked at 2:30 as an important time. It can sometimes, just like anything else, tell you something, and it can sometimes screw you over. But certainly in general, 2:30, like you say, if the markets are on highs at 2:30 and they're going to keep expanding the highs, there's a good chance they're going to go out on highs. So therefore, hey, I could just be long, right?
But
in your case, you're doing something else.
Yeah, well, generally speaking, I run 2 screens, right? So the first screen is, what environment are the dealers in? Are they going to be with? Is their hedging of their option replication going to be amplifying movements, or is it going to be compressing movements? Meaning,
all right. So let me interrupt you there. Yep. What environment are the dealers in? Okay, so they're either in an environment where they want to, you're saying, compress the vol?
Well, it's not that they want to. What happens is, okay, so let's say you're a dealer, and for today's example, they were in what we call a positive gamma Vanna environment, meaning they're most likely their hedging activity is going to compress volatility because of what their positions look like.
Well, let's start with that. They're in a positive what?
Gamma. So all gamma is,
they're in a positive gamma.
Yeah. So what that means is gamma is just the first derivative of the delta. And the delta just means if the stock goes up $1 and you have a 50 delta option, the option go up 50 cents, right?
Okay.
Even and all gamma tells you is if the option goes up from 50 to 70, how quick that movement is. So it just tells you how steep that curve is. So if the dealers are long a lot of options, they're long gamma. So what that means is they can react with a limit order mentality, meaning if the price goes up, they're long. So they'll sell some out. If the price goes down, they'll buy some, which will stop the market from going down more. And then they'll do that as the market trades during the day. And some of them won't hedge intraday. Some of them will only hedge toward the close. So like if they have a big book, they'll say, okay, well, it's, between 2:30 and 3:30, they're going to make a decision and they're going to hedge what they have to do. If it's something like last week when the markets were going kind of crazy, they probably did a lot of hedging on the open and they did the rest of it on the close. So it depends on how they have to react. Because if they're in a negative gamma environment, that means as the market goes down, they're getting longer. So they got to try to get ahead of that. So what they do is they sell in anticipation of where the market might land, and so they'll be flat at that level, because nothing worse being short an option and the market starts going down and it starts trending and it just keeps going down because you can't catch up to it, which is why these trades that I'm modeling, they're all bounded. So if I'm selling options like today, I'm selling a put spread, all I can make is X, and if it's 40 cents, I make 40 cents. I can only lose 60 cents, right? It's a dollar, right? So I know how much I can lose. I can't blow up. So if I'm selling a put spread or call spread, it's all bounded. A lot of guys will sell strangles, and you can make a lot more money with straddles, but it's unlimited, right? I don't like that risk reward. So everything I do when I sell options, it's a spread. It's either an iron condor, a call spread, or a put spread. And all an iron condor is a call spread and a put spread together. So, but you know how much you can make, you know how much you can lose. It's quantified. You know it going in. If there's only $1 on the spread and you collect 40 cents, well, you're risking 60 cents to make 40. That's generally the simple. Now, if we're in another environment where we're in negative gamma, and at 2:30 we're in one of the tails, the left side, the right tail, I want to bet the
negative. We're in negative gamma.
Yeah, which means the dealers are going to be over hedging in the direction of the market. So if the market keeps going down, they're going to keep selling. As it turns, goes back up, they have to buy back and get ahead of that. I was never good at unbounded short vol trading. I like to have it bounded. But what generally means is intraday, if we're down at the lows at 2:30, I'd like to buy some out of the money calls, because I think more likely something's gonna if the market starts to turn, I know all these guys have to start buying back all their hedges. So I'll buy an out of the money call or an out of the money put, or a straddle or a strangle. Sorry. So either one, buy the put, buy the call, or buy both. Right. So I have really 6 options, 6 particular trades that I can do based on the screen, whether I'm in positive and negative gamma environment with the dealers, and where we are in the distribution of prices between 9:30 and 2:30. So I'm either in the middle of distribution, left tail, right tail. Now, if I'm in the kind of one standard deviation between the middle there, sometimes it's not a trade to do because there's not a lot of edge, right? So some days there just won't be anything to do. But most of the time, you're going to be in one of the tails or the middle. It's rare. If you look at a distribution of the S&P, either when you model it either daily, weekly, monthly, it's leptokurtic, meaning there's high peaks in the middle, there's fat tails, and the shoulders are lower than a normal curve. So generally speaking, most of the action happens in the middle of the distribution or on the tails. And since it's fractal, generally that's scalable. Either it's intraday, daily, weekly, monthly. The distribution tends to be the same, where most of the action happens in the middle, and then there's not as many, and they're say 1.5 to 2 standard deviations, and then beyond that, that's where there's more than normally the normal curve would tell you. And that's just the way markets work because of the feedback mechanisms of the way people trade, right? Everybody's short or long a second derivative, whether it's implicitly or explicitly, right? CTAs aren't explicitly trading options, but if the market's crowded and it starts to go down, you know what they're going to have to do, right? It's essentially a gamma function. It's just not implicit. It's just a stop loss, essentially, right?
So why, in any of those scenarios, is trading options better than just trading futures? If you said, okay, we get to 2:30, we're on lows, and it feels like everybody's been selling, and there's a good chance that it's going to squeeze higher into the close. Well, why wouldn't I just get long futures? And
Yeah,
if
you can make. Well,
if it
that's
goes
the direction
down
of
5 points and takes out the lows, then I'll just get out and I'll lose my 5 points. I mean, what's better about trading options?
Because with options, I can collect premium on trades that I don't think are going to move that much. Like, look, between 2:30 and 4 today, would the market move 10 points? I mean, you could risk 3 to make 10 if you want to be directional, but why would I? Now, if it was a different story where we were in a negative gamma environment and we were on the lows at 230 and I thought there was going to be a rally. Well, maybe I'd buy the slightly out of the money call. And if I get lucky and we rally 50 handles, I'm going to make 10, 15, 20 to 1 on my trade. So on those short option trades, I can be wrong 10, 15 times in a row. And all I have to do is get one a month of the real big winners. And that's going to make my year. So it's much more of a risk management type of strategy where I don't have to be in the situation where if it hits my stop, I'm going to press the button, right? As soon as I put the trade on with the option trade, it's built in. It's going out. It's going to expire, and I'm either going to make the dollar or I'm going to make the 40 cents or I'm going to lose the 60 cents or whatever I did the spread for. And the same with if I'm buying out of the money call or put, that thing's going out cash value at 4 o'clock. I either paid for the premium and it went to zero, or the market rallied 50 handles and I spent 50 cents to make $12, right? There's just these things, you kind of have to stick around long enough to make enough money where you're making a little here, you're making a little there, and then you catch one or two of these every quarter. You can it's a lottery ticket essentially, because there's zero, and these things are crazy. I mean, there's so much speculation going on in these things now. 50% of the volume now in all options are 0 DTE. That's crazy. So
it is, but where's the edge? That's my question.
Well, the edge is.
I mean, to me, lose 60 to make 40. To me, sucks.
Yeah, but you're risking like 20 basis points. You're not risking 1%. You may be risking 16 basis points, right? Every day you're in there trying to pick up a few pennies, and then the days that you get one of these right, you're spending 50 cents to make $15. So it's a hugely positively skewed when you get one of these right. You'll have to get one or two right a quarter, and you're going to make some money.
But
but it all depends. The edges
you still need to do it better than the other millions of people that are doing this, right?
Yeah, but they're not screening for gamma exposure and where the distribution is. They're just looking at statistically and saying, okay, most option dealers, they're using essentially a normal curve to price options, right? They're not looking at it like probabilistically like you would with, let's say, the yen a month ago, right? The risk was high probability that if it starts to go, it's going to continue to go, right? But that's not how option dealers price things. They price things because they have so many options on their books that one of them, they don't care about one of them because they're hedging the whole book. So they're using some sort of a normal curve, and they're not assuming the positioning of anybody, right? To me.
So in the same way that I am looking at positioning in the futures market,
Yeah,
to develop where a non-linear
high risk reward, high probability trade is.
Not even high probability, but high risk reward, right? Whereas if it's wrong, I lose a little bit, and if it's right, I make a lot.
Yeah. The
same way that I'm doing that positioning in the futures market.
Yeah.
That is what you are attempting to try and do in a way in the options market by trying to figure out where these participants are at any time, right?
And how they're going to behave if depending, like, for example, okay, let's say the difference between COT being at 97 or 98% versus 50, right? So the way I would view it is when dealers are in a positive gamma environment, it's kind of like the 50% COT, where it's kind of random action. It could go up or down, but I think because we're at this point in price on the day, I'll sell the put spread or the call spread because I can make some money because I don't think it's going to do a lot, but it's probably going to move away from where I'm selling. Otherwise, if it's in negative gamma, then it's like a 1 or a 99, because if the market starts going down, they're going to have to hedge, and if it stops going down, it's going to turn and go the other way. So I have a pretty good idea of how these guys are going to behave if price does something different. And at 2:30, you got an hour and a half before the close. if the market's on the low and it's not going to crash, and I'm willing to buy an out of the money call for, I don't know, 50 cents, whatever, I have, 50 basis points maybe. Say, okay, well, if they start to turn this thing, I know what these guys have to do. It's kind of the same with COT. If everybody's short and it starts going up, at some point they have to buy. Well, I know these dealers are going to hedge their book on the close sometime between, let's say, 3 and 4. Then if it starts to go, then it's a huge. The other trades, the 50% COT type trades, are just the call spreads, put spreads. When the dealer is a positive gamma, you're just trying to make a little here there. But the real big trades are the one where you can get something right, where you buy an on-money put a call, and you have this 15, 20 to 1. I mean, I've seen some of these where, guys have made a huge 100-point S&P days. These guys have made like $25 on a 25-cent option. That's
Right.
crazy. But that's how these things are working these days, because there's so many people. And the good thing is, the dealers don't hedge 0 DTE options the way they hedge 1 month, 3 month, 6 month options. Those, they use deltas, right? They hedge with stock or S&P futures. They don't do that. A market maker isn't going to do that. Like I talked about earlier when I was working from Mulhern, you can't do that around the strike all day. You'll just cost yourself too much money. Right. So what they'll do is they'll trade other options further in and further out. So that's why these things start swinging and they move a lot. And if you get lucky, you can make your whole year in like 2 or 3 trades in a year. I mean, and the rest of the time, if you break even and make a little, that's happy. Just gravy.
Right. All right. So it's a low probability, very high payout thing.
Yeah. On the negative gamma environment. And the problem is, negative gamma environments are kind of like COT. They only show up like 15% of the time in a specific market.
Right.
The other 85% of the time, it's between 40 and 60 on the COT, and
So I mean, when it's this huge negative gamma thing, you're basically
I know these guys are going to have to hedge
buying premium, and when it's not, you're basically selling premium.
Yes, but bounded. So I'm only doing spreads because I don't want to, something might happen, right? Someone could blow up a car bomb, and I don't want to be short a put.
Sure.
So I'll sell a put spread, and for $1 wide, if I collect 37 cents, all I can lose is 63 cents, right?
Right. So
that way I can't blow up.
That's a risk management thing, and that clearly is what
it's built in. And then the good thing is there's no overnight risk, right? You're out of there by 4 o'clock, and you don't even have to think about it, so you can sleep.
Yeah, but I mean, it's like just like any good risk management thing. It sounds like it. You'll be in the game tomorrow.
Well, that's the whole point of it, right?
You have to be in. If you're trying to catch one of these big moves, the only way you're going to catch one is if you're still alive.
Yeah, and to me, it's like when I stopped managing my small CTA, I was so burnt out emotionally from having risk on every night for all those years. You know it. I mean, I just I don't want to overnight risk anymore.
I have no idea what you're talking about.
Yeah, I was like, so when these 0 DTEs came along, I'm like, well, this is perfect. At 4 o'clock, the book's zeroed out. There's nothing. It's just cash moving, because SPX cash or XSP, which are the mini SPX, they're all cash settled. The European options, it's all over at 4 o'clock. They don't exist. So tomorrow's a new day.
Well, that sounds like a good thing.
Yeah. Emotionally, yeah.
Yeah, but what fun is it if you're not completely out of your freaking mind every night and every day?
Yeah. I'm emotionally, I think I'm like 150 years old emotionally.
Yeah, I hear you. All right. Anything else you can tell me about any of this?
Yeah, see, a lot of this stuff seems complicated. What I'm going to do is I'm going to start offering some introductory option stuff. Like the first one is going to be like basic options. I'm going to go through and teach people what the Greeks are, what drives them, what makes them move, what happens if price moves or vol or time. And then that'll be your basic introduction to options for people who don't have them. And then I'll have an advanced one that kind of talks about higher level Greeks, Gamma, Vanna, Charm, Veda, things like that, and how to apply those to 0 DTE, and get into some of the stuff about, the action, the players I look at, the dealers, the vol control programs, the asset managers and COT, but that's more longer term. And then, any of that type of stuff that gives me as much context as possible of how different agents are leaning, where their positioning is, and how they're going to behave where the market goes. That's more the advanced stuff. But I'm going to probably try to set that up and, try to give people some education on that.
Okay.
I'm
And
definitely going to start with the basic shit.
where can people find this stuff, and where can they find you? Where can they find
Well,
this?
my new Twitter handle is Steep Greeks, and also on LinkedIn, I'm going to start promoting some of that stuff on there, so people can, people that don't have an options background, and I'm pretty good at. I mean, I know that I can solve all the equations because I was pretty good at math, but you don't need to know all that stuff. You just have to understand what these terms are and how price, vol, and time are going to affect things. And then you can trade options without having to know how to, do Ito's lemma or, understand partial differential equations. It's not necessary.
Right. You just have to know if the market's going to go up, down, or nowhere.
Well, you just have to know what environment we're in and how either the vol control programs or the option dealers are going to probably how they're going to have to behave if the market goes this way or that way.
Right.
And that, because look, everything we have now these days, even CTAs, you've noticed this, they're not just doing momentum anymore. Everything is a vol overlay, this VAR mentality, right? Realize vol went up, I got to cut my risk. Well, that's defeating the whole purpose of a CTA, but hey, let them do what they want. But everybody's doing it now. Every day they rebalance based on realized vol. And if you're not tracking that, you should be, because it's so fucking easy to predict. You just say, I know what they're going to do because vol went up and they have to take positions down.
Right.
I mean, it's mindless, but that's what they do.
Yeah. It is what it is,
Yeah, I mean, look, I'm not going to judge them. I just want to know what they're doing. Okay.
So I can make money.
Thanks for telling me what your reaction function is.
Right. Right. Well, that's interesting. All right. Well, cool. I'm still lost because I am brain dead with this shit.
Well, if you
But
want,
it doesn't matter because I don't want to trade options. I
yeah, you're
want
not going to trade options anyway. But
to do my thing. But
some of your followers might want
what
to.
is real quick something people can look at over the course of the day to try to figure some of this stuff out? Is there anything in particular? Are you looking at the put call ratio as it goes during the day? Is there a place?
Nah, I don't care about that, because generally speaking, one of the things that I track is the total amount of put gamma to the total amount of call gamma, and I don't look at that at the end of the day just so I can get an idea of.
Where do you find that?
I go onto the CBOE's website and I download every option on the whole board in the SPX,
Okay.
and then it's like thousands of pages, and you just there's a formula I have that just it looks at the closing price, the open interest, the gamma, multiplies it times the closing price times 0.01. Then I have the gamma exposure to each option. I total them all up, and then I take a ratio. Is the ratio above or below 1 call gamma versus put gamma in the SPX? Now they trade these things in SPY and a little bit in the futures options, but the most of the liquidity, the institutional players are in the SPX and the XSP. The XSP is just the mini of the SPX. So instead of $100 multiplier, it's the decimal point is moved over. So like where did the S&P go out today? 5,600, something like that. So in the XSP it would be 560, in the SPX is 5,600 or whatever. So these things are if you're a retail guy or you're a beginner, you want to play around, you can trade one of these options for like $35, right? It's one contract. You just multiply the price. Yeah, so 5608 was the close. So the XSP would have been 560.8, and the SPX is 5608. So the big one, that's you got one decimal place over, which is the full S&P. That's going to cost you, $400. The other one will cost you $40 to do one contract if it was a 40-cent option. So there's that's where all the volume is in those two. The other stuff is kind of retailish. the SPY, and they're not European options, they're not cash settled. You're going to end up getting exercised and end up with SPY contracts. You don't need that nightmare. You just want cash settled.
Okay.
The
That's
end of the
good
day,
piece of
you get
advice.
cash.
And what other places? Because I know for me, it's hard. It's always been a little bit hard to find good options data. So you
Well,
tell
you can
me you
do
go on the CME website. Is it the CBOE website?
CBOE.
The
That's where I
CBOE
get the end of
website.
the day. Yeah, that's good for end of the day data.
Mm-hmm.
And their intradays 15-minute delayed. But if you have if you have a brokerage account at Interactive Brokers
Mm-hmm.
and you tell them you're not a professional,
Mm-hmm.
you can get live option quotes for like $32 a month,
Okay.
which is nothing.
Right.
And
All
they'll
right.
give you every option on the CBO for $32 a month.
That's good.
Yeah, it's cheap as hell.
Is there a place to get historical options data? Do you know?
Yeah, you got to pay up. You got to pay up for that stuff.
I've never been able to find a good place for that.
Well, there is one firm, Option Metrics, but they're
Uh-huh.
not cheap.
Okay. And they're
We
giving
used when we were at Weiss, I used to get it all right off Bloomberg
right.
when I would track I created essentially a VIX for all the commodities that we traded,
Mm-hmm.
so I could get essentially a VIX for any of the commodities we traded, or the bonds, or the everything. And then I also created a term structure so I could look at the slope of the term structure,
Mm-hmm.
see whether or not it was in contango or backwardation.
Mm-hmm.
So that was kind of some of the stuff we looked at. But I got all the information off Bloomberg, and I don't know how much we were paying. It was probably like $3,000 a month. You know,
Yeah. Well,
rip off.
we weren't paying it, so
Well, no, but we were.
yeah, no, we were at the end. We'd come off of our stuff.
Yeah.
Okay, cool. So there's some places to get some data anyway, although it might cost.
Yeah, but look, if you're gonna today, I'm looking at the market. It's a 15-minute delay on the SIBO to look at the individual prices. What I'm doing generally is I'm looking at it and saying, okay, well, this is what I'm going to do. I know where the stock price is because that's free on CNBC. I can just look at it in just real time. So I know where it is. If I'm going to buy something, I don't want to pay the $32 a month on Interactive Brokers or whoever I have my accounts at.
Mm-hmm.
I put a limit order and say, okay, look, I don't mind doing this spread. I'm going to be within, depending on how much the market moves, between 230 and 245, because that's when you're going to be getting the prices. If you want to spend $30 a month, which is next to nothing, that's pretty much, I think most brokerage firms, Thinkorswim, all these guys, I can't see that they're going to be more than Interactive Brokers if you're not a professional.
Right. So that's the place to go.
Yeah.
All right, cool. Anything else you want to let me know or tell me or tell us or that we should know about this whole option
Well, look,
fiasco?
we can.
And I say that sarcastically. I do think that your points are important because, like you say, the options volume has just become in the last 3 years so big.
Yeah, it's huge.
Which is something new in the markets, obviously relative, in particular when it comes to S&P, right?
Yeah.
It's so big. And these dealers are, like you say, have such big positions on, and they have to hedge, and they have to delta, and they have to whatever.
Yeah.
That a huge, because there's so much options volume, a huge amount of the futures volume is then going to be driven by that option.
The hedging, yeah.
So I do think it's super important for people to start paying attention to this, and start tracking this, in particular if you're a shorter term trader.
Yeah.
Because this is really having a big effect on the shorter term movements in the market. There's no question about it. And if you can use that to your advantage because you're trading futures, that's great. Or if you can figure out a way to trade the options to use that to your advantage, then that's great too.
Yeah, and for me, the reason I do the options is just for risk management, because it's like, do I want to rely on myself that I'm going to press the button when it hits that stop level or whatever, or do I want to have that position overnight? I've spent the last couple of years trying to eliminate all existential emotional risks that I don't need.
No, I think that's great. I think that's very important.
We,
No question about it. It's like, can I trust myself that I'm going to take that stop when I need to take that stop?
yeah,
Whereas what you're doing, you don't have to trust yourself because it's doing it for you.
and it's all cash settled. So at 4 o'clock, the game's over. Now I
Right.
still trade some SOFR, and I've like the before you went away, we talked about I was trading some SOFR. I had this time spread on. I had the D's 24, D's 25 spread on.
Hmm.
Well, when we had that massive rally, I made money in the spread, so I legged out of the long end. I was long D's 24, short D's 25. So I flipped it. Now I'm just short D's 25, and that's starting to come my way now. So I kind of use that as a risk management because I didn't want to be directionally short into payrolls last month,
Right.
and I had that spread on. Well, the spread actually worked in my favor, and I almost got back to even on the spread. I took profits, like at 832 on that front on the long side, and now I'm just short the D's 25, and I'm almost back to where I started. So now if it's I kind of think that is going to get better. So I think everybody got too panicked and pricing in 50 basis points in September. So now I'm short the 25s, and I'll get out, but I'm so small. Like when I trade longer term stuff, I trade so small that I don't even care what it does, you know?
Looking like a true veteran of the markets.
Well, you can't, you just,
Trade small.
when you're younger, you can deal with the emotional drain, but it's like, do you really want to be doing something you like doing and thinking about some miserable position you have on? It's like, oh, come on, man.
That sounds pretty much like my life. Thank you for reminding me. Um, all right, cool. Well, I like it. It sounds good. You guys know where to find Mark if you need him. Um, and please let us know if you have any questions or comments. I'm sure he will be happy to answer them.
Yeah, especially with the basic stuff. That's why I'm gonna do like a 1 hour basic, well, 2 hours. I'm gonna do a 1 hour introduction. Like I said, basic options. The first hour will be me going through like a PowerPoint, the very basic. What is an option? What kind of options are they? What are the Greeks? How the Greeks are affected by price, vol, and time, and then an hour of Q&A. So it'll be very basic stuff. So someone can go from only thinking, oh, well, I kind of have an idea what an option is, to after 2 hours of doing this stuff, you're going to know what they are. And then the other one will be more advanced, and it'll get into like how to exploit zero DTE and how to watch real world market dynamics. That's when I'll get into the dealer gamma, the vol control programs, the asset managers on the CTA, because it's an interesting thing now. Back when we were just looking at the spec side, now what asset managers are doing now, like mutual fund companies, their positioning now is based on what they do is they call it equitization. So if they're underperforming the benchmark, they're allowed to implicitly use a little leverage, so they buy S&P futures. So that's why you see on the asset manager side, these guys are like the dumb money now. So because it's really hard to distinguish on the spec side and COT between hedge funds, like equity hedge funds that are hedging their stock exposure, and CTAs, right? So it's clouded on the spec side now, but the asset manager side, or the money manager side, let's call it, and the disaggregated, the asset managers, they're almost always completely long because they've underperformed and the market's making new highs. And these idiots go in and add beta to their exposure with the S&P, and they're almost always wrong. Like they get up to their full leverage, and you see, and it's like, okay, market's going to top, and it's happened both the spring and in August. They're the dumb money now in the S&P, whereas the spec side is harder to delineate because a lot of firms use S&P futures. Like if you're Millennium, you might have a stock book, but you don't want the beta exposure, so you hedge it with S&P. And is that a short spec position? Because the CTAs are going to be long that, so it's harder to get a clear picture of the COT on that now in the equity space.
Good. Cool. Well, thanks, Mark.